If you're 60 and have $2 million across all of your retirement accounts, how much income can you safely and sustainably take from your portfolio in retirement? Let's break it down. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today we're going deep on one of the most important questions I get asked by people on the brink of retirement, which is, how much income can I generate from my portfolio? We're going to cover 3 real-world strategies, tax considerations to keep in mind, and 3 portfolio makeup scenarios so you can walk away with real clarity. Having $2 million sounds like a lot, but what matters more is how much of that can you turn into income every year? And the answer depends on a couple of factors, such as your age and time horizon, your investment mix, your tax situation, maybe other sources of income like Social Security or pensions, and of course your flexibility. So let's look at 3 ways retirees approach withdrawals. The 4% rule is the most commonly used method. The way it works in simple terms is you withdraw 4% of your portfolio in the first year of retirement, and then adjust your withdrawals for inflation each year starting in year 2 and every year after that. So, for example, maybe 4% of your $2 million portfolio in year 1 is $80,000. Then beginning of year 2, you check inflation, and this came out at 3% for the year. So now what you do is you take your $80,000 and adjust it up by 3%, equaling about $82,400 in year 2, and so on. Now, this strategy supposes that you should have a high probability of not running out of money over 30 years. But let's go over the pros and cons. So the pros of using the 4% rule strategy is that it's extremely simple, and it's based on historical research from the Trinity study. And it's also reasonably conservative for most retirees. But there's also some cons, so here they are. This strategy doesn't adapt to market conditions. It can also be too conservative for flexible retirees, or too aggressive if you needed to retire early. Also, it assumes a 50-50 mix of stocks and bonds, which isn't what most retirees have, and it doesn't consider things like taxes or what allocation of funds you have in the various types of accounts. On top of that, it also doesn't account for the fact that your expenses may be higher in the first 10 years of retirement than your later years. For example, if you plan on traveling a lot or having expensive hobbies like the country club, etc. Now, this is a very simple to implement strategy, but it may not be the best fit. So let's look at the next option. Strategy number 2 is the income bucket strategy. So this strategy divides your portfolio into buckets based on your time horizon. Bucket number 1 is generally for the next 2 years, and it usually contains cash or cash-like alternatives. Bucket number 2 is for years 3 through 10 and usually utilizes things like bonds or income-generating investments. Bucket number 3 is for longer than 10 years, and it usually utilizes stocks and growth assets like index funds. Now, the way this works is you withdraw from bucket number 1 and then periodically refill that bucket from the other 2 buckets. So let's talk about the pros and cons for this one. The pros are that it helps provide peace of mind during market downturns. And it also matches assets to your spending timelines. But what are the cons? Well, it requires maintenance and discipline. And it may be inefficient if buckets aren't periodically rebalanced, which is very important. So to implement it, you determine how much you need in each bucket based on expected spending, and then invest accordingly into the various accounts. Again, this is a solid option, but it still might not be the best fit for everyone. So let's look at the third and final option. Strategy number 3, the Guardrails Approach. This method sets a target withdrawal rate with guardrails. If your portfolio grows, you give yourself a raise. If it shrinks, you cut back slightly. So here's a hypothetical example of how this works. If your initial withdrawal is 4.5% of your portfolio, you don't increase spending unless the portfolio grows by 20% or more. And then you reduce spending if it drops by 20%. It's a very interesting strategy. So let's look at the pros and cons. The pros are that this is the most adaptive strategy, and it optimizes spending while protecting portfolio longevity. But what are the cons? It's way more complex to track, and it takes discipline to stick to it. But this strategy is good for retirees who want a balance between stability and flexibility. Now, let's walk through what your after-tax income could look like in 3 different portfolio allocations, assuming you want to withdraw about $80,000 per year using a moderate strategy. So, scenario 1. Let's assume for this scenario that you have $1.2 million in pre-tax accounts, like traditional IRAs and 401ks, and that you also have $500K in Roth accounts and $300K in taxable brokerage or savings accounts. Now, usually you would withdraw first from your taxable account and then begin pulling from pre-tax IRA accounts or 401k accounts, saving the Roth accounts for last. This doesn't mean that this is right for you, but it's just a generally normal approach to the withdrawal strategy. On top of that, a portion of the taxable withdrawals would be taxed as capital gains, and the pre-tax IRA withdrawals would be taxed as ordinary income. If you strategically blend these sources, you might owe roughly 12 to 15% in effective tax rate, which means from your $80,000 withdrawal, you could keep about somewhere between $68,000 and $70,000 after taxes, as an example. Scenario number 2, for this one, let's assume that the $1.2 million is in the Roth accounts now, the $500K is in the pre-tax accounts, and the $300K is still in the taxable accounts. This is basically the opposite as the first scenario. Now, with a majority of your funds in Roth accounts, you'd have much more tax-free income flexibility. You could withdraw nearly all $80,000 and pay little to no income tax. So your after-tax income might be somewhere around $75,000 to $79,000, depending on capital gains in the taxable account, if you're withdrawing from that. Okay, now let's look at scenario 3. For this one, let's assume you have a 50-50 even split of pre-tax and Roth funds. You'd probably blend your withdrawals from both account types, maybe withdrawing 50% from each, which would help keep you in a lower tax bracket while preserving some Roth funds for later. This likely results in an effective tax rate around 10 to 12%. Now, after-tax income would be around somewhere between $70,000 and $74,000. And these are all estimates, but they show how your income mix directly affects your retirement paycheck and is vital to understand going into retirement. So with all of this in mind, how much can you actually spend? Well, using a 4% withdrawal rate, the starting point is $80,000 per year. But taxes, your mix of accounts, and your strategy will change what you actually keep. So if you're willing to be flexible and spend less when markets are down, adjust as needed, or delay Social Security, you give yourself more options. And if you optimize withdrawals from the right account types in the right order, your $2 million can last 30 plus years while still supporting a strong retirement lifestyle. So whether you use the 4% rule, buckets, or the guardrails approach, the right withdrawal strategy can give you confidence, peace of mind, and the freedom to enjoy your retirement. And it's not just about portfolio math, it's about how that income supports your real life. So if you want help creating your custom retirement income plan, feel free to visit us at greenarrowfinancial.com or reach out to me at any time. I'd be happy to help you if I can. Thanks for watching, and I'll see you in the next one.